There is no greater financial pain than buying a stock at a new high, your mind filled with visions of a swift and powerful journey upward, only to watch it falter, hesitate, and then collapse back into the price range from which it came. It takes your money, but worse, it takes your confidence. This is the breakout trap, the market's primary instrument for punishing the hopeful and the impatient. It is designed to lure you in at the point of maximum optimism, and then slam the door shut. Many traders believe that buying breakouts is a coin toss, a matter of luck. They are mistaken. Distinguishing a genuine move from a fraudulent one is not a mystery. It is a science. There is a formula. It is a formula I paid for, time and again, with my own capital until the lesson was permanently etched into my mind. The market teaches through pain, and the tuition is expensive. If you wish to learn these lessons at a discount, the first step is to study the past. The patterns of greed and fear never change, and they are all documented in the book that chronicles my career, Reminiscences of a Stock Operator. I suggest you acquire a copy and study it until its lessons are part of your very being. A link is in the description of this video. But for now, pay attention. I will give you the formula to turn a simple price movement into the beginning of a life-altering trend. The foundation of this entire enterprise rests on understanding the pivot point. The public sees a number on a chart, say $50, that a stock has failed to break through. They see it as a ceiling. This is a crude and incomplete picture. A pivot point is not a price, it is a battleground. It is the visible line in the sand where the accumulated supply of stock is being absorbed by a new and powerful demand. For weeks, sometimes months, a stock will trade in a narrow range. This is not a period of inactivity. It is a period of immense, silent struggle. The insiders, the composite operator as some call them, are quietly accumulating shares from weaker holders. Every time the stock approaches that $50 pivot, sellers who bought lower are tempted to take their profits. Others who bought at $50 on a previous failed attempt are desperate to get out even. This selling pressure creates the resistance. But underneath the surface, a large interest is absorbing every share offered without bidding the price up aggressively. They are a sponge soaking up the floating supply. You can see this on the tape, or what you would call your real-time data feed. The volume dries up on declines and picks up slightly on the rallies toward the pivot. The price range tightens like a spring being coiled. The longer this period of accumulation, of basing, the more powerful the subsequent move will be. A breakout is not the beginning of the buying, it is the culmination of it. It is the moment the large operator has absorbed all the available stock at a discount and is now ready to let the real move begin. Your job is not to buy during this basing period. That is tying up capital in a dead money situation. Your job is to wait with the patience of a sniper for the exact moment that the battle is won. That moment is the breakout. But not all breakouts are created equal. Most are feints designed to trap you. The formula for identifying the real one is based on 3 specific points of confirmation. The first and most vital piece of evidence is volume. I will state this as an unbreakable law. Price without volume is a fiction. It is a rumor, a ghost. A stock can be manipulated to any price level on thin volume, but a genuine move that will carry for dozens or hundreds of points requires immense power. It requires the fuel of heavy, aggressive buying. When a stock approaches its pivot point after a long period of accumulation, you must watch the volume like a hawk. A false breakout, the kind that will ruin you, often happens on average or below average volume. The stock may poke its head above the $50 resistance level by a few cents or even $1, but the buying is anemic. There is no urgency, no force. This is often the work of pools or manipulators trying to entice the public into buying so they can sell their own shares at a higher price. They are creating the appearance of strength, not the reality of it. It is a painted picture of a fire offering no warmth. A genuine breakout is the opposite. It is an explosion. As the stock touches the pivot point, The volume should surge to 2, 3, 5, even 10 times its recent average. You should see a stampede of buying on the tape. The price does not just creep above the resistance, it smashes through it. This is the signal that the silent accumulation is over, and the phase of aggressive marking up has begun. The large interests are no longer trying to hide their buying. They are now competing for shares, driving the price up to attract momentum. This surge in volume is your first non-negotiable confirmation. It is the thunder that validates the lightning of the price move. If you see a stock break a key level, and the volume bar on your chart is no bigger than any other bar from the past few weeks, you must consider it a lie until proven otherwise. Do not commit a single dollar. Patience in this moment is the highest form of discipline. Wait for the power. If it does not come, the trade does not exist. The line of least resistance has not yet been established. The second piece of confirmation is the action of the group. Stocks are like people. They move in crowds. They belong to families. The steels, the motors, the oils, the rails. A single stock breaking out while its brethren are asleep, or worse, are in decline, is a soldier charging into battle alone. He may be brave, but he is doomed. The market is driven by broad currents of capital flowing from one industry to another. For a major trend to begin in a stock, the entire sector must be receiving that flow of capital. Before you ever place a trade on a breakout, you must do your due diligence on the entire industry group. I kept special books, meticulously organized, that tracked the leaders and laggards in every key sector. If Anaconda Copper was making a new high, I would immediately check the charts of Kennecott and the other copper stocks. Were they also strong? Were they confirming the move in the leader? Or were they weak and sluggish? If Anaconda was the only one moving, I considered it a danger signal. It could be a move based on a specific rumor or a manipulation, not a fundamental shift in the industry's fortunes. A breakout with sector confirmation is an entirely different animal. When the leading stock in the strongest group breaks out to a new high on explosive volume, and you see its sister stocks also firming up and beginning to follow, you are witnessing the start of a true market advance. The odds shift dramatically in your favor. You are no longer betting on a single horse. You are betting on the strongest horse in the strongest stable at the precise moment the race begins. The public buys stocks. The professional buys into a market trend, using a leading stock as the vehicle. This requires you to look beyond the single chart on your screen. You must have a broad view of the entire market landscape. You must know which groups are attracting capital and which are being liquidated. To buy a breakout, no matter how perfect it looks on the chart, in a sector that is out of favor with the market, is to swim against a powerful tide. It is a low probability, high effort trade. The great moves, the ones that build fortunes, come from buying the confirmed leader of a confirmed group. This is the second law. A breakout without companionship is an orphan and should be avoided. The third and final confirmation is the character of the price action immediately following the breakout. A true move has a certain feel to it. It has authority. It has power. When a stock decisively breaks through a key pivot point on heavy volume, with its group in tow, it should not look back. The path of least resistance has been cleared, and the stock should now move upward with ease and speed. It should not struggle. It should not hesitate. It should not give you a second chance to buy it back at the breakout price. One of the most common and dangerous traps is the breakout and fail pattern. The stock pierces the pivot, perhaps by $1 or $2, triggering a flood of buy orders from amateur traders. Then, within hours or by the close of the day, it sinks back below that pivot level. The sellers have overwhelmed the buyers, and everyone who bought the breakout is now trapped in a losing position. This is a sign of profound weakness. It is the market's way of telling you that the move was fraudulent. My rule was to watch a breakout with extreme scrutiny. I would often make a small probe, an exploratory purchase, right as it broke. Then I would watch. Did the stock continue to advance? Did it close the day strong? near its highs, or did it sag and show signs of weakness? A stock that closes back below its pivot point after breaking out is a stock you must sell immediately, without question or hesitation. You are wrong. The market has told you that you are wrong. To hold on, hoping it will try again, is to substitute wishful thinking for tape reading. It is financial poison. The character of a true move is relentless. It holds its gains. Any pullback in the first few days should be minor on significantly lower volume, indicating that there is no serious selling pressure. The stock acts right. It feels strong. This is a subtle art, one that comes from watching thousands of breakouts. But the principle is simple. Strength begets strength. A move that starts with a powerful, confirmed breakout should continue to exhibit that power. If the character changes, if weakness appears, you must honor that signal above all else. Do not argue with it. This is the third law. A breakout must be decisive in its character, or it must be abandoned. So you have the formula. A well-defined pivot point, an explosive surge in volume, confirmation from the leading stocks in the group, and a decisive character in the price action after the break. When all four of these elements align, you have a high probability entry into what could become a major trend. But getting in is only the first part of the battle. Turning that breakout into a major trend requires an entirely different skill set, the art of sitting tight. The money is not made in the buying or the selling. The big money is made in the waiting. Once I had a position in a stock that had confirmed its breakout in this manner. I learned to have the courage of my convictions. I was no longer interested in a 5 or 10-point gain. I was playing for the big swing, the 100-point move that can define a year. The public is constantly tempted to snatch a small profit. They buy a stock at $52 after it breaks a $50 pivot. It runs to $55, and the fear of losing that small gain becomes overwhelming. They sell, patting themselves on the back for a successful trade, only to watch in agony as the stock proceeds to $150 over the next 6 months. They win the battle but lose the war. To capture the major trend, you must ignore the minor fluctuations. The market does not move in a straight line. There will be reactions, pullbacks, and periods of rest. A stock that has run from $50 to $70 might naturally react back to $62. This is normal and healthy. The amateur sees this as a reason to panic and sell. The professional who bought correctly based on a confirmed breakout understands this is just noise. He refers back to his initial analysis. Has the major trend reversed? Has there been a climactic top on massive volume? Have the leaders of the group broken down? If the answer to these questions is no, then there is no reason to sell. The reason for entering the trade is still valid. To sell would be to act on fear, not on evidence. This is the old turkey wisdom that the old speculator, Mr. Partridge, so often preached. He would get in right and sit tight. His simple explanation was, well, it's a bull market, you know. He captured the great swings because he did not allow himself to be shaken out by the meaningless day-to-day wiggles. He had his position, and his position was right, so he stayed. Therefore, the complete formula for turning a breakout into a major trend is a two-part process. First, the rigorous scientific identification of a valid entry point. You must wait for the evidence to be overwhelming. You must see the coiled spring of accumulation, the explosive volume of the breakout, the confirmation of the entire sector, and the decisive character of the subsequent move. You are a detective looking for clues, and you do not act until the case is beyond a reasonable doubt. Do not anticipate, react. Wait for the market to give you its unmistakable signal. The impulse to jump the gun, to buy a stock just before it breaks out in hopes of catching the first penny, is a fool's game. You will be wrong more often than you are right. Be a little late. Let the move prove itself. Pay $1 more for your stock, but buy with the confirmation that the line of least resistance is truly clear. The second part is the psychological fortitude to manage the trade correctly once you are in. This means adding to your position, not selling it. If I bought my first lot at $52 and the stock acted right and went to $58, that was my signal to buy my second lot. The trade was proving me correct, and the market itself was financing my increased risk. You must suppress the human emotions of fear and hope. You must operate based on your system of rules. You hold the stock not because you hope it will go higher, but because the technical evidence has not given you a reason to sell. The moment that evidence appears, a broken trend line, a failure of the leaders, a massive volume reversal, you must sell just as dispassionately as you bought. There is no loyalty to a stock, only to your rules and the preservation of your capital. Let this be the final law, the synthesis of the entire process. A breakout is not a trigger for a gamble. It is the final piece of evidence in a carefully constructed case. You are the prosecutor, and you do not go to the jury until your evidence is irrefutable. Your evidence is volume, group action, and price character. Without all three, your case is weak, and you will lose. When you receive this threefold confirmation, you must act decisively, but your work has only just begun. You must then transform from a detective into a stoic guardian, protecting your position from your own worst enemy, your impatience. You must allow the trend to mature, to run its full course, knowing that the greatest profits come not from nimble action, but from disciplined inaction. This is the formula. It is not easy, for it requires the rarest of all human qualities in the market, supreme patience. But it is this formula that separates the fleeting profits of the gambler from the enduring fortune of the master speculator. It is how you turn a one-day event into a multi-month journey. It is how you turn a breakout into a trend.